Welcome, everyone. My name is John Hutchinson with Traders Reserve. This is our final summer installment of the Options Testing Lab. And today I'm going to introduce you to a new concept we've come up with called the Stack. It is an options trading strategy that we've been testing during the current bear market and has the potential to work just fine in bull markets too. Really excited about this because this is the culmination of months worth of testing. But my humorous point to start today is usually whenever we've held webinars with options tactics or strategies, the number one question we always get is, how does your thing work in a bear market, right? Today we can answer that question because we're in a bear market and we've been in a bear market for the last 6 months. And as far as I can tell, that bear market isn't going anywhere, despite the fact that we keep asking it to. So what we've been doing, and the reason we've been holding these special options testing lab events this summer, is over the last year plus, we have been testing more than 20 different options trading tactics. And our objective in testing them was to identify tactics or groups of tactics which could work either on their own or cooperatively, regardless of the direction of the market. We had certain conditions that we set around these tactics, and what we wanted was to identify which were the best performing tactics. Now, best performing does not necessarily mean highest return. Instead, it meant more consistent production of income. And we've also been trying to identify tactics which have lower capital requirements. And I'll talk a little bit more about that in a couple of slides, but that bullet there, tactics with lower capital requirements, is your first line of defense in a bear market. If you can reduce capital without sacrificing income, you have better potential to beat the market. And what we've discovered through this testing is these tactics ranged in time, meaning open to close, anywhere from 4 to 160 days. Naturally, we've thrown out the 160-day trade. And we also wanted tactics which could be defended or rescued, because as you can see on the left side with the S&P 500 chart for the year, we've had 5 separate legs lower in the charts this year, and multiple recoveries. They're not necessarily recoveries because we're still in a bear market, I realize, but there's still periods where the market turns around and rises, then turns around and falls. And so in those types of market environments, I call this an unstable market, you need to have tactics which can be defended, meaning you can either decrease a loss, bring a loss back to break even, or turn a loss to a profitable trade. So through our testing, we were looking for tactics, or we've been testing tactics, which could meet that kind of a requirement. And that led us to 4 core factors in the testing that we've done over the last 15 months. Those factors had to do with the frequency, meaning how often could this trade tactic be used. So for example, that trade tactic that was 160 days, well, you could only reasonably place that a few times a year, given the capital requirements and other conditions. But a tactic that maybe 4 or 7 days, you can use with much greater frequency. And the greater frequency then increases the annualized return potential for that tactic. As well, the consistency of the tactic, meaning the volume for trading options was present, the consistency in available strikes and expirations, and even premium. The probability of the tactic, meaning the win probability. Obviously, I don't want a tactic, or don't want to use a tactic that starts with a 20% win probability. I want tactics that start with 70% or higher. And finally, performance. And performance, again, is not gravitating solely to highest performing, highest return tactics, but instead consistent performance. Because if you know, for example, that you can get 5 or 10% per trade, then that is a consistent level of performance when coupled with frequency you'll see this, you have the potential to substantially increase the overall value of your income uh, based on that performance, because that performance happens regularly or can have it happen regularly. Through all of this testing, what we actually found was if we put 4 of the tactics together, which we had been testing, these 4 tactics alone could nearly triple a small account. They had the recovery options that we needed, meaning we could reduce the overall risk in the trade. All of these tactics used defined risk uh, parameters, meaning the maximum loss was known in advance. And most importantly, they resulted in an overall 95% reduction in capital required. That's that bear market tactic. When you can substantially reduce the amount of money that you have to put into the market without sacrificing the money you can take out of the market, that is your first line of defense, as I've said, but it's also a way to treat a bearish market in a bullish way without being overly aggressive. And put together, these 4 tactics generated an average weekly return of 8.1%. I'll show you the numbers on that in just a little bit. So across these 4 tactics, the capital reduction was one of the biggest factors that caused us to put them together. And the capital that you see on the screen here, the numbers that you see on the screen here are based on the 4 tickers that we have traded with the tactics. And I'll be going into all of that here in just a moment. But on a single-sided options basis, meaning selling a put or selling a covered call, the average capital required based on those 4 tickers ranges from $3,000 to $19,000 for one contract, versus the 4 concepts that make up the stack ranging from $370 to $520 at one contract. And you'll see this as I walk through each of the tactics in the upcoming slide. This is a way to think through how to reallocate capital in smaller doses using a series or a group of tactics that can still produce income, but protect more of your portfolio. As I get to the last slide here, I have a really good comparison for you that will help show you that. But I want you to keep that in the back of your mind. If you can trade using less capital but still make income that is consistent with what you were making with the capital you were using, then you have something that is more powerful, and you have a way to guard yourself, to protect capital, preserve capital during ongoing bear market events, which is exactly what we're living through at the present time. Sorry, somehow we went back to the beginning there. Give me a second. There. So, introducing the stack. This is 4 tactics, making 4 trades total across the 4 tactics using 4 tickers. That is, at its simplest, the way that we've put this together. You can expand these tactics out to use more tickers or to make more trades. We have not to this point. And when you see the results, you may feel like you don't have to go beyond or take another step beyond what I'm sharing with you today. And the reason for that is because all 4 of these tactics, when put together, have a range of time frames from 4 days to 45 days. That's the life of the trade from open to close. But within that trade lifetime, they are producing income each and every week. So even the 45-day trade, roughly 6 weeks, is producing income on a weekly basis. The 4-day trade is obviously the fastest, which means that plus the 7-day trade gives you 2 tactics you can use practically every week to generate income. But all 4 of these tactics, even together, use less risk and require significantly less capital, as I've shown you, for the weekly income that they can produce. So I want to take a dive into each of these and break them down for you. We'll start with the 4-day income trade. We've been trading the IWM, that's the Russell ETF. And for this tactic, we actually started trading this in early August. So it's the newest edition to our little group of tactics. And it was this one which caused us to realize we had something when we put these 4 tactics together. And what's different about this trade, to start with, is this is a rule-based strategy, meaning there are specific criteria which need to be met before you ever enter a trade. This is also not a maximum income trade. We're not trying to get the 100% of net credit, so to speak. In most instances, we're collecting anywhere from 30 to 60% of net credit. And historically, this strategy has an 80% win probability. So it has a very high success rate. In our actual testing, these are real money accounts that we've tested over the last 11, 12 weeks. Excuse me. We have made 11 trades. We have not yet had a losing trade in our testing. I will give you the standard caveat, though, that at some point we will have a losing trade. To date, we have not. But what's interesting about the fact that we have not had a losing trade, as you look at the chart there, that's the Russell over the last 11 weeks, the IWM, excuse me. And you can see a couple of pretty big red bars, which we've navigated without having to take a loss. And that's instructive and important because it increases the win probability, the win rate, and allows us to keep using this tactic on a weekly basis. So the way that we're trading this is using 10 contracts with average capital of just under $5,200 for those 10 contracts total. The average length of time in trade is 4.2 days. So sometimes shorter than 4, sometimes a little bit longer. Total income collected to date, $2,890, or roughly a 50% return on our average capital used per week, per trade. At a minimum, this is at a 1 contract basis. This trade tactic requires about $520. It is producing average weekly income of $26 at 1 contract. Now, I know $26 doesn't get anybody excited, but when you add that, start adding that up, whether you're trading 1, 2, 5, or 10 contracts, this tactic works in your favor by being able to rack up capital income on a regular and consistent basis. But those numbers together give us an average weekly return on this tactic of 5%. That's what we've achieved over the last 11 weeks. And you can see the IWM, since we first started trading it, is down 10%. From its August high, it's about the August 15th high, we're down 15.5%. So we've been trading this straight through a declining market, and we've traded it profitably. And this is true of all 4 tactics, and I'll share this with you on each of them. Let's move on to the overview of the 7-day income trade. And here we've been trading the XLF, that's the Spider ETF for the financials. And you can see that on this chart, the XLF is down 23.5% since January 1. These are closing prices as of Black Friday, by the way, not inclusive of today. And since the mid-August high, the XLF is down 13.33%. The real benefit to this tactic is it is a very low capital requirement, which allows you to scale contracts. You can do this with any of our tactics, but this one especially because it's literally a weekly income trade. So you can set this up on a Friday, on a Monday, close it out 6-7 days later, and then repeat the process. And the benefit to this particular tactic is that it allows us to manipulate trades based on the movement in the market, meaning as the market moves up or down from week to week, we can move with the market because we're constantly closing a trade and opening a new trade. So numerically speaking, we've been trading this at 10 contracts per trade. Our average capital per trade, roughly $3,900. The average length of the trade is 6.8 days. Overall income generated from our testing, $6,826, or a 174% return on capital. On a weekly basis, this is requiring approximately $400 for 1 contract, sometimes a little more, sometimes a little less, generating average weekly income of about $33 or 8.25% on a weekly basis. Our 28-day trade takes a little bit more explanation. Those of you who attended our special event back in late July and early August had a preview of this. We've been trading the SMH, which is the semiconductors ETF. That ETF is down 39% year to date, or 22% from its August highs. You can see really the deterioration in the market has taken place in the last 40 days or so. This one is different because it requires 4 initial trades to get set up before you start generating income. I'll show you that on the next slide. But over the last year that we've been trading this particular tactic, and this is our longest running tactic, we've maintained about a 78% win probability. Average capital, one contract, is $380. The average weekly income in that time is $74, one contract, and an average weekly return of 4.8%. Since April, however, we have been trading this at 3 contracts per trade. Average capital per contract of $1,140. Average capital for those 3 contracts of $1,140, and a trade that averages about 28.7 days. We've generated a little over $4,300 in income. Again, this is because of the way that this trade works. It takes time for that income to build up, but that's a 96% return on our capital. I'll show you a little bit more on that here on the next slide. This one tactic, though, if you can get through the first 4 weeks, it's what I'll call a waiting period, is a tactic that you can use to generate consistent income every week, in part because for the first 4 weeks, you're opening trades. We've been doing it on Fridays. So you open your first 4 trades on successive Fridays. On the 5th week, you close the oldest trade, in this example, trade 1, and then open a new trade, which I'm calling here trade 5 on the right side of the calendar. That's where the income collection process begins, in that 5th week. And then each week thereafter, you would repeat the process of closing the oldest trade and then adding a new trade to replace it. Now, just because we've been trading it on Fridays doesn't mean that's the only day that you can do this. You could do this on a Thursday, you could do this on a Monday. It's just to make the point that the first 4 weeks, because these are actually using monthly expirations or farther out expirations, you have to set up the first several trades to begin. Then once that income collection process begins, you just repeat it week after week after week. But that is my way of explaining why the weekly return is 4.8%, because if you did the actual math in your head, the $74 per week at $380 per contract is actually a 19% return. But that return has to be divided by the 4-week period, which is what gives me the 4.8%. The other brief explanation on this one here, average capital that we've been trading is $1,140 per trade. However, in a monthly basis, you have to account for the 4 weeks that you're setting up. So the actual capital in a month is $4,560. And that's why the return is 96%, right? So we're using on average just under $5,000 per month in capital, but over time, we've generated almost that full amount in gross income, in the net income. That's the explanation behind the waiting period for the 28-day trade. And finally, one that I think we're having the most fun with, this is the 45-day income trade. This is on a stock, Caterpillar, which we have used multiple times. Caterpillar trading down 20% since January 1, 30% from its year-to-date high, which was back in about mid-April. What is unique about this is a no shares covered call tactic, meaning you don't have to own 100 shares to sell a covered call. You don't have to use a leap. We're not buying leaps, and we're certainly not doing naked calls. So there's a unique construction to this trade, which is different. And what it allows us to do is to sell covered calls or roll covered calls week to week to week. And that's how this particular tactic generates income on a weekly basis, even though the life of the trade is 45 days. We've been trading it at 10 contracts per trade, average capital of $3,700. Again, with Caterpillar trading in the high 100 to low $200 per share, you can see the capital reduction there is substantial, especially given that we're trading 10 contracts. The average life of the trade is about 44 days. We have produced just over $10,000 in total income, or a 291% return on that capital. On a one contract average, though, it's average capital of about $370, an average weekly income of about $71, or a weekly return of 14%. And that's from rolling those covered calls from 1 week to the next. The other thing that's unique about this trade is, and we will be testing this in the weeks going forward, we can also use puts with this trade, meaning we can sell put against the core of this trade, generate income in rising markets. So here we've been selling calls in somewhat choppy and declining markets. We can actually reverse this and use put too. We haven't tested it yet. That'll be a test that we'll be doing in the upcoming weeks. But that's one of the things that I'm really excited about with this particular tactic. So when I put the performance together at a single contract level to show you sort of minimums, minimum expectations, minimum potential, the tactics on the left side here, the 4, 7, 28, 45-day trades, making just one trade per week, using total capital of about $1,600, that capital ranging from $370 to $520. I've shared with you the tickers that we've been trading, and generating average income per contract of $26 to $74 gives us gross potential income on a weekly basis of $204 at one contract, which is an average weekly return of just over 8%. In our actual application of these four tactics, however, we've been trading between 3 and 10 contracts. So our total capital on a monthly basis, $17,460. Remember, as I showed you with the 28-day trade, we have 4 of those operating in a monthly period. The 4-day trade here, I assume 1 per week, realistically, to a degree, based on the rules or depending upon the rules of that strategy. You could make more than 1 4-day trade across the breadth of a year. But we're accounting for this we only want to make this about every 4 days or once every week. We don't have to be more aggressive than that. Certainly not with the results that we've achieved so far. 7-day trade, again, can be traded on a weekly basis. With the win probability on that one, it's fairly safe in that regard. And with the 45-day trade, the way I account for this one is we've been making about 1 of these per quarter. The life of the trade is 6 weeks. So if you made 4 of those trades over the course of a year, that would account for 24 total trades. So, but you're still only making 1 trade per week because you're either selling or rolling the covered calls. Put together, that gives us weekly income potential of $1,543 and annual income potential of a little over $58,000, or a 334% annual return. This is the frequency and consistency in performance that we discovered when we put these tactics together from our testing process over the last several months, and actually as long as a year with the 28-day trade. It was here where we started to realize we didn't have to have 1,000 or 2,000% return. If we could, it's like taking an axe to a tree. If you just keep hitting the tree, eventually the tree falls, right? So if we just kept generating income on a weekly basis by using the same amount of capital on that same consistent basis, the overall annualized return was going to be substantially higher because of that consistency and because of that frequency. And that's all that we did. This is not, I don't want to say that this is not magic. The discovery was being able to put these 4 tactics together so that you could easily manage trades. You had something to do every week, but you weren't inundated. You weren't overwhelmed with trades. You weren't trying to manage 20 or 30 trades at any one time. By keeping it as simple as we could and no simpler, this was the process that we were able to come up with from the actual testing and trading that we've been doing. And when you compare this is the slide that I mentioned earlier, the comparison slide. In a bear market, and then this bear market is not over. I don't know how long it's going to last, but I do not see it ending before December, and likely not before or until, at a minimum, first quarter of next year. That's, if anybody watched our Filthy Rich Dirt Poor video series last week, I gave you pretty much all of the setups for the fourth quarter. And I'm going to come back later this week and show you why I think there's, Jerome Powell said it, there is pain to come. Which means you as a trader have to decide how you're going to continue to generate income in declining or unstable markets, which is what we have. When we do this comparison, on the left side, we have the stack, and on the right side, we have selling puts, right? That's as simple a strategy as you can execute. And I'll say right up front, there is nothing wrong with this strategy. This strategy can still work in a bear market. Using those same four tickers, the capital required across them is about $55,000. And over the weekend, I looked up the current weekly put options across each of those tickers, and their values ranged from 20 cents to $3.80 for one contract. So on a one contract basis, that would generate weekly income of about $749. That's a 1.3% return on capital for the week. And there is nothing wrong with that number, nothing at all. The challenge, the difficulty for you is that's $55,000 in capital and one assignment, and you start to get nervous, you start to get worried. So if we could meet or beat those kinds of numbers, but substantially reduce the capital outlaid, then we knew we had something that could outperform in a bear market. And that's what the stack does. That $17,000 in capital is 70% lower than the put seller's capital requirement, generating twice, on average, the potential cash income. And it's that output that got us very excited. But we haven't gone deep into the specifics on these, and I'll explain why in just a few minutes. But I wanted you to see how just putting together a small group of tactics can significantly decrease the capital requirements. Well, you're not sacrificing anything, you're gaining on the income side. That's what got us very excited about bringing this idea of the stack to you. And I'll leave you with sort of like the Captain Obvious question of the day. What are your choices right now? The S&P is down 23% for the year, 14% since August. There's no good news that's going to turn this market higher. Every turn in the market higher has been caused by hope. Hope that the Federal Reserve will stop raising interest rates. Well, they haven't. Hope that inflation will come down. Well, it isn't. That is the difficulty that we face, and that is what is creating an unstable market. So your choices as an investor or as a trader, you could do nothing or keep doing what you're doing. It may still work out. Many people, I think, are going to sell and sit on the sidelines. I think that selling may intensify as next month occurs, because everybody knows all the crashes happen in October, right? You can play the stock market game called guess the low, buy the market low. You might be right, you might not. Bonds are at historic highs, well, not historic, but they're at 20-some year highs, paying 4%. You can go to the casino and gamble. Any of those are reasonable options right now. Or you can learn to put the stack to work. This is a weekly cash income options strategy. By putting these four tactics together, we have the potential to generate substantial income, reduce our capital in the market so we protect and preserve more of our capital. And if the more that we can protect and preserve now, then when the market does become stable, it is much easier to put more capital to work even at the basic put seller's objective, if you're selling single-sided options. But how can you get through the next 6 to 12 months? That's how we came up with this idea of presenting to you the stack, 4 tickers, 4 trades, 4 tactics, generating weekly income, significantly reducing the capital needed, and generating substantially higher returns. And the way to learn how to put the stack into action is going to be at our second annual Millionaires Trading Club. live and virtual conference taking place this October 17th and 18th. This is where we will be teaching and trading all 4 components to the stack, plus much more. And I'll walk you briefly through everything that we're doing for the Millionaires Trading Club conference. We're just under a month away from the conference, so very excited about the full lineup that we have here. We have 6 individual guests and experts and traders attending and hosting their sessions. Michael Schulman, all of you, most of you know. Dave Durham and Chris Davis will be leading the stack, much of the stack for you. Haley Bjorklund, if anybody attended Investors Blueprint Live, she is coming back. She is now a registered financial advisor, and she has something new and interesting to share with investors and traders. Jeff Wood will be teaching the 4-day income trade. He is the one who developed the strategy and has been trading it over the last month, generating the results that I've shared with you. And Jerry Allison, who's a tax expert. I'll share with you what Jerry will be covering. On October 17th, though, the first day of the conference, we're going to dive right into making money the first 3 sessions. All times listed here are Pacific time since we'll be in Las Vegas. So add 3 hours. And I'll make a bigger point about this here in just a little bit, but 8 a.m., 9 a.m., 10 a.m., we will be live trading 3 of our tactics, the 2 of which are in the stack, the 7-day income trade and the 45-day income trade. Michael Schulman will be teaching his 1-day income trade. That's the approach he uses in Income Madness. Each of these will follow the same process. We're going to give you the strategy overview, show you how to build the trade, and then trade it with you. So first thing on Monday morning, from 8 a.m. to 10 a.m. through 10 a.m., Pacific time, or 11 a.m. to 1 p.m. Eastern time, we're going to dive right in and start trading with you. And then in the afternoon, we're going to switch around to our training and coaching model. Haley will be teaching undiscovered income. This is a new income stream for investors. It's not available in the market, so she'll tell you how to access it, what its potential is for you, and what you can do with it, which is unique and interesting. Jerry Allison will be helping individuals learn how to pay less in taxes. He has advantages, disadvantages, things you can do to legally pay lower taxes as an individual. Michael Schulman will be teaching a short version of his 7-figure portfolio. These are the approaches to generating income on a larger portfolio, even in bear markets. And finally, at 3 p.m. on the 17th, Dave Durham and Chris Davis will be doing something that I asked them to do this summer, which was to lose money on purpose, meaning selling a single-sided option, allowing that option to fall to assignment, and letting the price go below assignment, and then developing a series of simple tactics to work that back rapidly to break even or profitability. So they've had a number of trades where they've been doing that, literally losing money on purpose to help show you how to make it back. And then and then at 4 o'clock, we have a special presentation for all of our 5K Income Challenge members. Everyone's invited to this. It's just a little something fun that we wanted to do for the 5K Challenge members who are in Las Vegas with us. So we'll be broadcasting this. And then Tuesday morning at 8 a.m., we'll be back with live trading, 8, 9, 10 a.m. again. And Jeff Wood will be leading you through the rules and the setup for the 4-day income trade. He'll show you how to build the trade and how to make the trade. Michael Schulman has a new concept he's bringing this year called contrarian option selling. He'll give you the strategy, make live trade, and then share 5 of his best ideas for continuing to trade this tactic going forward. And then Dave and Chris will finish up with the 28-day income trade strategy, building the trade, and the live trade there. Then on Tuesday afternoon, we'll switch back over to the training and coaching model. Dave will be taking a 1-year look at the 5K Income Challenge, everything that we've learned, other discoveries that we've made over the last 12 months of the generating 5K per week from $100,000 portfolio approach. Jerry Allison will be along to help you on business entity taxes. That's for investors or traders who are considering trading as a business entity, like an LLC or LLP. Jerry will be sharing with you the pros and cons of trading so you can decide if it's right for you. There are advantages to trading as an entity, and he will be sharing all of that with you. Michael Schulman will wrap up the afternoon with a deeper dive on the 7-figure portfolio. That's building and constructing the portfolio And then trading the portfolio, you're going to have a group of stocks. You're going to put those stocks into your portfolio, not in-person portfolio, but in the coaching portfolio. And then it'll show you how you can approach trading them on a weekly basis to hit your income goals. And then we'll close at about 4 p.m. For the people who are in Las Vegas, we will have office hours, both morning and afternoons. We have a poolside reception on Monday from 5 to 7 p.m. And new this year, 3 breakout groups for members of Small Account Trader Pro, Income Masters, and the 5K Income Challenge, taking place both Monday and Tuesday, as listed here. Breakout groups, we're also going to try to broadcast to our virtual attendees. We're working on the process for that, and we'll let you know exactly how to do that as soon as we get closer to the event. Give me just 1 second here. So one other point that I wanted to make, since we are in Las Vegas for the Millionaires Trading Club, I know attending a webinar from 11 a.m. to 7 p.m. is not easy for East Coast people. So if you think about this, if you could only attend the live trading sessions, that's 11 a.m., noon, and 1 p.m. each of the 2 days, everything else will be recorded for you. Or as a virtual attendee, you'll also have come and go privileges. So if you find that there are specific topics that you absolutely don't want to miss, you don't have to miss them, but you also don't have to sit and be a slave to your computer or our broadcast for all of both days. Now, obviously, we'd love to have everybody be in attendance, but we know it's not realistic, which is why I make this point. There are 6 live trading sessions for you to use right off the bat on Monday and Tuesday to generate income with us as we make live trades. So if everything else is recorded for you and will be available to you through our members website and our Traders Reserve app within the next day, you'll be able to keep up with the conference pretty easily. So keep that in mind. And I do want to stop the recording here because